Welcome to Grow Fast, Grow Smart, the PI Playbook by Accelerator, the podcast exclusively designed to help personal injury law firms reach their full potential and serve their clients better. Today's episode is hosted by Micki Love, president of CJ Advertising and co-founder of Accelerator Law Firm Consultants.
Hey friends, Micki Love coming to you today with another exciting playbook podcast. I've got with me today a good friend, Dr. Howie Golden. Dr. Golden, it's so great to have you on the podcast with us today.
Thank you for having me today. I appreciate it.
Yeah, you've got such a wealth of industry knowledge that I'm excited to share your journey and what it is that you have to offer to all of our listeners today. But before we do that, why don't you tell everybody the name of your company and a little bit about what you're doing, and then we'll dive in to the background and bring everybody forward on all the cool things you've done over the years.
I'm the CEO and managing partner of a company called Capital Financing based in Atlanta, Georgia. And we like to say that we're innovative and really trying to challenge the status quo of what we see in the personal injury industry as it pertains to financing, and trying to really be game changers in what we're doing.
Yeah, I was super excited to meet you when I heard how you guys are going about this and what it is that you're doing and how unique this is to the personal plaintiff injury side of business. So with me, I love all things that make law firms have easier access to capital that's going to make their cases worth more money and their clients get a better settlement. So I think what you are doing and what you're bringing to the table is certainly unique and certainly something that law firms need to hear more about so that they understand how they can grow their firms while they get the maximum dollars for their clients as well. Tell the listeners a little bit about how you got here. I know that you have been a practicing physician for a long time. I imagine that you've seen quite a few injury patients over the years. So just walk us forward a little bit, if you don't care, from your background.
Well, my story, or my journey, I like to call it, is I guess they always say it's always best to stay in an industry that you know well. As you alluded to, I was a physician for 18 years. I actually retired in 2014. Prior to that, I hosted the largest personal injury seminar back in 2002 that was hosted in Atlanta and Orlando, called Understanding Colossus. So for those that I'm dating, we sought out the most, the most well-to-do speaker on Colossus. His name is Jim Mathis back in the day, and we were the first to put lawyers and chiropractors in a room together. And believe it or not, they actually got along, which is rare for the doctors and everybody to get along. And he was speaking to trial associations back in the day, and we offered him the opportunity to put doctors in a room with him to learn what was necessary to beat the insurance companies at their game. And the conferences ended up being very large. From there, my partner and I had an aha moment. We built a technology platform that's still around 18 years later, called the Injury Specialist. And that was meant to connect all the attendees at the conferences so they can collaborate. But the model changed, and we started a very large SaaS model from that, where currently, 18 years later, we have over 300 medical providers, 60 plus imaging centers, a few hundred law firms, all in a technology platform, able to refer business to each other and help facilitate medical care for those that are uninsured or underinsured. And back in 2006, when we started that, it was unheard of from the medical profession to actually treat patients on LOPs. So there was no way for people to get access. So we were the first to launch a concept called medical funding, which is no longer a unique concept. It's been around a long time, but we were the first to break through this in the East Coast. And we were trendsetters, I guess, or disruptors of the industry. And then from that success, we were approached in 2009 by some lawyers here in Georgia that asked us to get involved in the pre-settlement plaintiff financing industry, which we had no clue what it was. And we quickly learned the negative connotation, or the negative stigma that this industry had we were asked to see if we can solve the problem of the high interest that was being caused, and we had to research it. And we spoke to our lawyers and their staff, and we got a very quick understanding of the negative impact that plaintiffs getting loans was causing to cases, the impediment it caused at settlement. It's no different today than it was 14 years ago, but we were interested in trying to solve another problem and disrupt the industry. And our initial thought was, well, if everybody is compounding interest for years and they're charging 200 to 400% interest, we got to do something different. And we were the first probably in the industry. I think there was nobody else that was doing it, where we have a terminating interest model. And we thought that what better than to do something nobody was doing. And when we walked through the doors and said what we were doing, they would tell us, you had us at hello. And that's exactly what still happens 14 years later. Ironically, we were told we'd be out of business in 6 months. How can we do this? We're not going to make any money by the other companies in the industry. And the law firms thought the same. And 14 years later, 30 states later, and staff around the country, I'm proud to say we have the same business model. And we have always called ourselves a plaintiff-friendly model, and have never shied away from how we do it. And that is where we don't charge compounding interest like everybody else. And instead of, we see companies today evolved and they cap their fees at 2 or 3 years. Nobody that I have seen is at 12 months along with no compounding interest. So that's how we kind of separated ourselves. And that's the capital financing business model that launched in 2010.
I love that. I do think that so often the plaintiffs are taken advantage of, and that's a harsh word to use, but with these some funding elements that are out there, if they don't have a good plaintiff lawyer looking out for them, looking for the right way to get funding for them, it certainly can be one of those instances where a client appears to be taken advantage of by some type of loan or funding company that may not be as plaintiff friendly. So I appreciate where you're coming from and can see how what you're doing is certainly helpful. You've had a chance to look at a lot of law firms and the way that a lot of law firms are handling expense funding or plaintiff funding for different medical procedures. What is the most common mistake or I don't know if mistake is the right word, but what is the most common setup or fallacies that you see with law firms when they have their own line of credit to pay for this versus what you guys offer, versus some other models that you've seen inside of firms?
So I'm glad you asked. So in around 2019, I was asked to get involved with litigation financing in the traumatic brain injury space that was coming out of California, and it was cutting edge. And as a doctor dealing with concussions and things of that nature for many years, I was fascinated to learn what was going on. And I was asked to help out with the financing because the expense to do the diagnostic testing was very, very costly for law firms. And these companies did not want to work on an LOP. And they wanted to get their money up front. And it was beyond the cost that some law firms can afford, and some law firms just simply didn't want to take the risk. So I cut my teeth in starting out in this litigation financing space doing that. And then I decided and kind of had another aha moment that seems to be my career. And I said, wow, if I can do this for TBI testing, which is considered a case cost because the law firms were writing the check, why can't I look at doing all the case costs for a law firm? And I started to dive into this, and I started to realize how this whole business model, this is what I came quickly to learn, that law firms were using their money. They were investing tens of thousands, if not hundreds of thousands, if not millions of their own dollars, tying their money, their capital into cases for months to years that they can't use anywhere else. They were giving their clients an interest-free loan for all this time, and they were taking all the risk. And when I really put them all together, I said, that is the most draconian business model I have ever heard. And has anybody thought about doing something different? Is there a better mousetrap? Is this just the status quo? And then I got to learn that law firms typically cover their case costs by either an operating account or a line of credit. And as I started to dive into those two components, I really started to understand the flaws in both of them. And what I recognized was there was an unwritten or undiscussed conversation amongst lawyers about this business model. And they weren't talking amongst themselves all the problems that they were having because they were putting money into cases or they couldn't qualify for a line of credit. And that's kind of where I started to look at how can I next impact this industry and do something innovative like I had done before. And I realized that I had the concept. And then over the last, after since COVID kind of like put the kibosh on a lot of business, mine included. And around 2021, when I started going to conferences again, that was when I really started to go out there and start to brand this case expense financing model that nobody, Micki, was doing. Lines of credit were out there, and there's banks that do lines of credit and specialty financing companies that call it case expense or case cost financing, but they're investing in the law firm by giving them a line of credit. And I looked at doing something completely different than what they were doing.
And so when you say it's completely different than what they're doing, maybe you can tell the audience, explain to them just a little bit. I know you and I have talked about it a few times as we worked on some clients together, but I think it's really interesting for firms to understand kind of the difference between using a line of credit versus the work that would go into working with someone at your company to help bring the financing to life for a particular case or case expense. And, I'm not sure that the audience may grasp the entire concept yet because we haven't really got there, but I would really like for them to understand just those subtle differences. I think it's pretty easy when you talk about the difference between their operating account, where all their capital gets tied up on these case expenses. But I think the firms sometimes have a harder time drawing the conclusion between a line of credit and where that's more efficient versus using someone like you who can really help them on those per case basis.
So the first thing you realize with a line of credit is it's really an obtrusive process.
You almost got to
And
sign away your firstborn to
yeah,
get.
exactly. It's intrusive, and not everybody can qualify for a line of credit. If you're a new law firm, you've left a firm and you're starting out on your own, banks are not readily going to give you a line of credit because you don't have history and collateral. You may not have the type of personal financial statement they're looking for. So I learned quite quickly that lines of credit were really for the one percenters. And then those that had a line of credit from the bank, they were usually very small. It didn't really get them very far. Um, then I started to learn some interesting things about those that were using lines of credit. There's actually between the different institutions that you can have a line of credit, like a traditional bank, like a community bank, versus a specialty financing company, like maybe an Advocate Capital. So your listeners may have lines of credit with Advocate Capital, which is usually a line of credit that they do is minimum of a $250,000 line, and the interest cost can be pretty expensive. And then there's companies like Esquire Bank that have been in this industry for 20 plus years. They understand the legal industry. They offer lines of credit, but their starting line is 750,000, and not everybody can qualify for that. What you learn with a line of credit, although it's wonderful, if you're getting it from a community bank, there's no way to track the money that they're using that money for. So if you're using it for case costs for a client and you have multiple different expenses in a particular case, and that law firm is writing checks, money can go into that case at different times. And then when the case settles, say in 27 months, how is that law firm going to figure out how much is actually owed to that law firm in interest costs that they've incurred that they should pass on to their clients? And you learn very quickly that most law firms are not passing the interest costs on to their clients. They're actually absorbing it and taking it as a loss. So a line of credit is also it's a recourse loan, and if you lose the case, you lose your money as well. Lines of credit also require the law firm to pay a monthly interest payment to the institution that they're borrowing money from. That also depletes cash flow, and it affects law firms differently. If you have a large line of credit, it could be a very large payment. If you have smaller amount of line of credit being used, but you're a smaller firm and cash flow is problematic, you can't afford to be writing checks every month to cover those case expenses. At the same time, most law firms don't even know what the line of credit interest rate is. So that's another problem. But the advantages of other companies, like I mentioned, where you're dealing with Esquire, Advocate Capital, they do have technology platforms that allow law firms to track the money in and money out to effectively know how much to then charge the client at the settlement of a case. So there's different ways that a line of credit can be used, and different companies are beneficial in different ways as well.
Is there a particular firm size that you work with? Are you taking small clients through extra large clients? What does that typical client look like for your company?
So when I started this model, I really thought, when people asked me who would be my best client, I really thought the small starting law firms that were maybe minority law firms would be really the ones that I can impact the most. They'd have the most cash flow issues, challenges getting lines of credit, and they would need my capital to put into their cases. But I learned really quickly that I started to talk to very large law firms that had a lot of money of their operating account tied up or large lines of credit tied up. And the visceral response that I was seeing from them with their aha moment that, oh my gosh, this is brilliant what you're doing. And if I don't have to put my money into cases and I don't have to use a line of credit and pay a monthly interest payment to the institution, this is a much better business model. So what I've learned is that the largest of firms with millions of dollars tied up in cases to the firm that has $20,000 tied up and they're 2 years old, and they all have different problems and they all have different pain points. The key with what I try to do is ask the questions, learn about the firm, and see where I can be the best partner in what I do and solve their problems, which is different for everybody we work with.
Sure, I can appreciate that. Talk to me a little bit about, because I'm one of those that have had to work the cases for years. So tell me how easy it is if I'm working a case and funding needs to happen for a particular client. How easy is it to get access to fund that case? What do you need from the law firm to make that happen? Like, what's that process look like?
So our typical process is really an interview with a new law firm that would like to work with us and learns about us through introductions or at conferences, or I speak around the country, and that may be another aspect of how they find out about us. So we spend around an hour really, investigating their firm and their pain points and where we can help them. And then what we do is, if they are interested and they're the right candidate for what we do, and they're interested specifically in the case expense model, we will set up a follow-up short 10-minute onboarding implementation call. This is a really important call. It's quick. And what we do is we then go over any questions we have with them, but we basically cover with them the paperwork that we have that they need to implement. We do everything turnkey. We provide them language that they can put into the retainer agreement that allows them to work with capital financing. We give them instructions on where to send a case, or if they want us to get involved in a case, where they can send it to, and the information we need from them to start doing the underwriting that we need. It's actually a very easy process that we make for them. Doesn't take much of their time. And I think what's really cool is what we do is we really go over there's different verticals, which you and I haven't talked about. There's different advantages and ways in which our financing can work for them. There's two different verticals that we actually bring to them that they've never seen before. And we
Can you give us a little insight into those two verticals? What are they?
A little plug there for me to be able to do that.
You got me intrigued. Tell me more.
So when we started, the idea of a line of credit is where these institutions invest in the law firm. That's really what a line of credit is. And what I learned is that there's really two reasons why a law firm, a contingency law firm, is putting their own money into a case or may have a line of credit. And there's two reasons. Number one, their clients can't afford it themselves. The plaintiff can't afford to put their own money into their cases. Number two is the only way that a law firm can build their case is by putting their own money and getting experts, life care planners, accident reconstructionists, depositions. That's how they build the case. But one of the things that we uncovered is that contingency lawyers, plaintiff PI lawyers, are the only lawyers in the entire industry that put money into cases and don't get a retainer and ask their clients to pay up front. Divorce lawyers do, criminal lawyers do, corporate lawyers do. They all do, except contingency lawyers, because their clients can't afford it. Now, if their clients could afford to put their money into the cases, would any contingency lawyer, any plaintiff lawyer ever do that again? The answer unequivocally would be, of course not. Why would I tie up my money into cases if my clients can pay for it themselves? So our model looked at the approach of not investing in the firm like a line of credit, like we talked about, but actually investing in the actual case. And that's what makes us so unique. I haven't seen anybody think outside the box to do this. So we evaluate and adjudicate the actual case merits, the facts of the case. And that way we invest in the case on behalf of the client, of the plaintiff. So instead of the law firm having to put their own money into the cases, because really, Micki, there's no fiduciary obligation that a lawyer has, a law firm has, to put their own money into a case. There's no moral reason. There's no bar ethics reason. They do it because there's no other option. So what we're doing is we are now getting them to rethink. We're getting lawyers to rethink their approach in a different way, in an organic way. And if there was a better mousetrap, would they consider using something that was not maybe their own money? So what we have learned is that they are getting the permission through the language that we provide to them, where their client is authorizing them to borrow our money. So now it's a commercial litigation type of approach. They're asking their clients, or they're providing to their clients language in the retainer agreement, that the client is authorizing them to use capital financing for their case expenses because they don't have the money to pay for it themselves. So now the law firms are having to rethink their entire model and their entire approach, and by which authorizing that law firm to sign off on their behalf to borrow our money for their own case expenses. Because truthfully, this is the client's case expenses. This is their case. And the lawyer's putting money in many regards, especially the operating account, is impacting law firms all over the country with cash flow issues, the risk they put in. And the reality is that they can't use their money in other aspects of their business, such as advertising or operations, when their money's tied up for years. So the concept is where law firms are saying to themselves, this is great. I don't have to put money into the cases. My clients are allowing me to borrow the money on their behalf. And then the fees that I charge are then just simply passed on to the client at the end of the case at the settlement. What that does is it also benefits the law firms that are using lines of credit, because they don't have to pay the interest cost every single month, the money in their own bank accounts, using it for their own firm. So there's two aspects, there's two verticals that we mentioned. The first one is where we will cover the costs of a third-party vendor's fees that are about to be incurred. So a traditional law firm would get a bill from a doctor for a deposition or an expert to be paid before the service is provided. That's how it works. So they write a check out of their operating account or their line of credit, and they go about their merry way, and the service provider provides the service. Now with us is they simply will take that invoice and send it over to capital financing, along with the case information, policy limits, demand letter, police report, the things that we would need to adjudicate a case. And if we like the case, we approve it. We send the contract specifically to the lawyer and lawyer only. We do not involve the client. Client doesn't need to be involved any longer because they've already authorized the law firm to sign off on their behalf to borrow our money. We already provided the language to the law firm on the onboarding, and that's what they're going to put into this. So once we approve it, we can write a check directly to the expert. We can write a check directly to the life care planner or the doctor or whoever we need to write a check to. So now the law firm is no longer having to take that extra step in doing it. We then wait to get paid at the end of the case. Now, every single expense that that law firm would incur in that case, we can go about the same activity as we just mentioned. We can pay them as they go. That's the first vertical. The second vertical is the one I love the most. It came out of the blue, where I was referred a client by another lawyer, and this attorney had 25 years experience, and he ran into a problem. He couldn't make his overhead. And he said, I have heard that you're very creative. You think outside the box. Can you help me? I said, sure. I've never done anything like this before. And I said, what do you need? He's like, well, I need to make my overhead, which is $30,000. And I said, well, let me think. I've never done this. I've always paid for expenses as they're being incurred, but you're asking me to help you figure out a way to pay for your overhead. I don't give you lines of credit. Let me ask you a question. Do you have cases that you have money tied up, like capital tied up of your operating account? He said, I do. Yes. I said, well, if you can send me a couple cases that have money tied up equaling an aggregate of $30,000, I can look at underwriting those and possibly reimbursing your operating account. And he said, wow, that's a good idea. So that's exactly what we did. He sent me actually one case, and we were able to reimburse him $32,000 on that one case. And the case settled in 45 days for $750,000. And that was the birth of my reimbursement model. So now when I meet a new law firm for the first time and they learn about this, the low-hanging fruit is they all have money tied up in cases. And when they hear from us and they speak to us and they realize that their business model is flawed and they're tying up their capital and they're giving clients interest-free loans and taking risks, and they are advertising and want to put more money into CJ advertising and all the things that you do, but they can't because their budget's too small because it's tied up money in cases. What we do is we say to them, listen, there's no reason for you to have your money tied up. What we can do is we can review your cases. You send us a simple ledger of a case of all the capital you have tied up, all the expenses tied up. We need information on the case, which again we provide to them what we need to review. They send it over to us, and then if we like the case and they're asking for whatever dollar amount, if it all makes sense and we can do it, we will actually reimburse the firm back the capital that they have tied up in their case. It could be a line of credit or it can be their operating money. It doesn't matter. And they both have the same benefit because we do this non-recourse. This is the key with this. When a lawyer puts their own money in a case or they're using a line of credit, they're all at risk. I do this at no risk to the plaintiff. And of course, where the law firms are not investing their own money anymore, they're no longer at risk either. So the reimbursement model has been probably the greatest surprise, ironically, because it frees up the capital for these firms. And then those that are using lines of credit, again, they're not having to pay monthly payments any longer, or we can pay down that line of credit for them so their monthly payments are a lot less. So really it's become this two-edged sort of, we can get involved in a case at any juncture with any law firm whenever we meet them. They can write their own checks, put their money into it. They can cover all their case expenses, and at a certain time in litigation, if they don't want to put more money into the case, all they got to do is send us an itemized ledger of all the case expenses, and we can reimburse them back. It's just amazing how it's just changed the game for law firms.
I love that. I'm a big proponent of making sure that the firms have a way to pay their client expenses without utilizing their operating capital, obviously to grow their law firms for many ways, right? From an advertising standpoint or just being able to continue operating, paying their team, etc. I did have a question. So most of us are used to a model where as soon as the case comes in, at least our clients, we're going to start building those cases in that first 90 days. It's the most critical piece of that case, we believe, obtaining police reports, getting initial ER records. So we're incurring expenses from the very beginning. And I heard you mention that just at the end of that conversation you were just having with us. But I wanted to just circle back and say, what do you need from a law firm if they're going to use you on every case from the beginning? Do you do that? And if so, are you just looking for a police report to verify the merits of the case to begin with? Or do you see firms using a mixture of you and a line of credit if there's some gap in time where you guys may need to evaluate the case versus when they have expenses start occurring?
We get involved in the case as long as there's $1,000. Maybe this will help you. And if I'm not correct in answering your question, we'll get involved as long as there's $1,000 of case expenses. We don't get involved under $1,000, like filing fees and things of that nature. So typically a law firm is still going to utilize their own capital for some degree. Most law firms do get us involved in the litigation phase when it gets expensive.
Okay.
ability to reimburse them at any time as long as there's an aggregate of costs that they put in over $1,000.
Perfect.
And I want to say this too. I think it's really important. Where it's a game changer is we've identified that when we started doing this, I think it's so important that law firms tell us that they settle cases sooner than they should because they don't have the cash flow to cover their operating expenses. That's a very common thing with a young law firm. They are telling their clients that the case got an offer on the table. This is what we got to take. And they're doing it for their own personal needs. It's crazy. We're shocked. A lot of law firms have a lot of skills. They're talented lawyers, but they get a commercial case or they get a case that's going to involve a lot of capital to put into it. They end up having to give it to other law firms because they can't manage it because they don't have the money. Now they're splitting contingency fees on a great case and they can handle it. How sad is that is actually what's happening to a lot of lawyers, where a lot of lawyers, they don't have the capital to put more money into a case like another expert, or they may not be able to get the best expert. So they get the $3,000 expert, not the $10,000 expert. And I think what has happened is a business model like this, where we have more capital that we can invest in their case on their behalf, we have the ability to allow law firms to not settle cases sooner or give cases to other law firms where they split the contingency fee, or they can get the $10,000 expert and not the $3,000 expert. So there's so much to that, but I'm not sure. I probably didn't answer your question, but
That was actually perfect. I was curious at what level you guys start to get involved and how that happens. So I think that's good and is clarifying for those that are listening. I think that'll be super helpful.
I will say this. Again, it goes back to the different law firms. So a lot of law firms don't want to have any capital tied up in their cases. Like a young law firm that's been out for not that long, they're in the first 3 years, they need every bit of capital they can to hire staff and grow and do the things that they need to do. So we find that even in the pre-litigation stage, we may get involved with helping them out. And usually it's a reimbursement at that level. Then some other law firms may just get us involved just in the litigation phase when it starts to get expensive. And there really is never a bad time to get us involved. A law firm can write a check out of their own company accounts and go as their merry way. And at any juncture, if they feel like they have too much money tied up in a case, that is when they can send us over the ledger and we can do a reimbursement. So it's really flexible to how that law firm chooses to work with us. A new law firm just learned about us and they sent us an elevator case with $100,000 tied into the case. They're all in on this case. And he learned of our model and he's a big advertiser in Louisiana. And he said, man, he goes, if you reimburse me money, I can buy more billboards. And he has $3 million, right? He has $3 million, Micki, $3 million tied up of his own money in cases. And by the way, check this out. I did not know this until probably a year ago. Most law firms don't even know this. When you put your own money as a law firm, your operating account money into your case, there's IRS tax code that is treated as income. It's the wildest thing. You're putting your own money into a case, but it's not treated as an expense. It's treated as income. And you're taxed as pre-tax based on your effective tax rate. So if you're a law firm with $3 million tied up of your own capital in cases, by the way, it never goes away. Yeah. It's like a Ponzi scheme. It never goes away. It's until you retire, you got money tied up, right? He's paying effective tax rate, whatever, call it a 40% tax rate on the money that's tied up in the cases that gets passed through to him through his K-1 that he's got to be able to pay up front on that case. Most law firms don't even know about that. Their accountants don't know about it. And then there's, of course, the law firms that do. When they find out about what I'm doing, and again, it's commercial litigation where they're borrowing my money. By borrowing my money, it takes out that IRS tax code implication that they have to deal with where they're being taxed because they're borrowing my money. A line of credit is the same thing. It's when they use their own capital in a case. So there's another strategic advantage for a law firm to not use their money, and they've never had a better solution until now. Yeah. crazy.
Absolutely. It is crazy. And it's crazy that, in this day and age that law firms are still missing out on opportunities such as these. I just feel like we don't need any more billboards in Louisiana. So if you could tell your client just to slow down just a smidge, that would be awesome. I'm kidding, but not. Just kidding. What I would like to say is that I do think what you're offering is super valuable to law firms. And if there's a law firm out there listening to us today and you're using your own capital to fund your case expenses, you owe it to your firm, to your clients, to yourself to reach out to Howie and see how his product can help you guys. Howie, if they wanted to get in touch with you, what is the best way they could do that?
So my email is howie@injuryfinancing.com. My website is injuryfinancing.com. Is giving my cell phone appropriate? Do people actually call from a podcast to a cell phone?
You know what? We'll put it in the notes as well. So go ahead and give it.
That's 404-376-7342. And if you don't mind me giving an extra plug,
Yeah.
I don't want law firms to take the plaintiff financing opportunity lightly either. I know we discussed it at the very beginning.
Yeah.
It is a negative evil, or can't get around it. It's the necessary evil, I should say. And the clients are going to continue to need help and support. And all I ask is for law firms is to make sure that you vet the companies you work with. Make sure you protect your clients from themselves. And know that there are companies out there doing the right thing, whether it be capital financing or another. Make sure that they're transparent, you know what their terms are. And, that is something that we have taken pride in. And for a company like ours, we don't want to be a financing company for a law firm. We want to be their partner. And that's exactly how we approach this, Micki, is that we come from a whole different concept of how can we help them? How can we add value? And that is where we partner with law firms rather than just be a financing company. And that's what makes us, I think, unique.
I love that. I do love every vendor that we get a chance to work with. Everybody that's listening to this podcast that knows myself or Chad knows that we only put vendors on our podcast who we trust to do the right thing by the client first, by the law firm also. It's very important to us, very important to this industry and what we're trying to represent out there. So Howie, thank you so much for joining us today. Before we go, I always like to ask, is there a book that you've read recently that you've enjoyed that you would recommend to others to read?
I don't have time to read a
In your
book.
spare time?
No, I think like many of us, we listen to podcasts now just because you can, like you're doing. There's a reason why you're doing this. And I've been fortunate to be on other podcasts myself. So there you have an audience. I can't say that I have read a book, but I can tell you that I love self-help books. I'm always looking to learn, of course, business books. I think my first business book I read that had the biggest impact on me is, without a question, was E-Myth by Michael Gerber.
Oh, yes, that's a good one.
Right. Depends on the version, but I learned so much from that. It's always the book that I recommend to a young entrepreneur looking, or those that are struggling to try to take themselves out of the business and be able to, not take on all the roles or get out of that small business mentality. So that would be the book I'd recommend, but not the book I just last read.
Well, I do enjoy that book, Working on the Business, Not in the Business. Great Gerber quote that we like to reference all the time. So this product that you're offering is one of those times people can step back and work on the business by figuring out a way that they can utilize the capital they already have tied up to continue to grow their firm. So thank you so much, Howie. I truly appreciate it. Everyone, for the love of PI, I'm Micki Love, and thank you for joining us today.
That's a wrap on another eye-opening look into the personal injury world. Thanks for listening to Grow Fast, Grow Smart, the PI Playbook by Accelerator.